Hello and welcome to the Monday Futures Market Outlook for December 10th, 2012. This is Patrick Serezna. Our eminisource.com trading room it trades S&P futures every single morning live. If any of you are interested in trying a free trial, complimentary memberships are available on our website. In addition, all of our intermarket analysis is documented and published in our monthly Market Timing Strategist newsletter. To learn about the Market Timing Strategist newsletter, visit the website. As always, we'll start off with a chart of the U.S. dollar index futures, and we have a U.S. dollar that's really at a mixed point. We had just a recent little pop higher, particularly driven by weakness in the euro and the concerns of continued economic weakness in the eurozone. This really puts the U.S. dollar in a very neutral stance. We're going to change our risk-reward proposition from poor to very neutral. We don't believe that at this point the U.S. dollar really is going to gain too much momentum below that support line around that 78-75 level down below. Equally, we don't feel that the U.S. dollar is poised to make substantial strength above 82, and we're sort of right in the middle of that range. At this stage, we feel that this range-bound kind of zone will define several months of trading, and therefore we really want to look at this in a very neutral manner. Next year, we're going to take a look at that euro. You can see the euros came off several hundred pips off of its highs and is consolidated. While again, we don't necessarily think that the trend has changed on the euro just yet. We will be watching very importantly what the euro does in the 128 to 129 zone. So long as the selling that started last week gains a footing and doesn't really gain any momentum on the downside, there's still room for the euro not only to retest that 130-150 focal point above, but still has the potential to strengthen a little bit higher to the top end of the ranges. This doesn't make us in the big picture bullish to euro. We're just identifying short-term trends that may be in place for the next month or two on the upside. In the bigger picture, we think it would not be constructive for the euro to gain much more than the 132 to 135 on the upside, but certainly that is something that will be playing out in the first quarter of the year. Next year, I want to take a look at the 30-year Treasury bonds, and we've have a substantial overhead resistance, and the Treasury bonds remain relatively range-bound at the top end of this range, and they're teasing with the idea that these Treasuries can break out. The 10 years are already kind of bouncing their head right up along the overhead highs. This means that we may see interest rates even fall to historic lows if these can break out on the upside. One way or another, whether they are able to muster up new highs, we still believe that the risk-reward proposition of actually owning these bonds is pretty poor. And while a swing trader or a short-term trader can try to clip some points on the upside, catching quick moves, we don't view this as a very good proposition in owning it beyond some short-term trades. Next year, we're going to take a look at copper futures, and copper has been relatively strong in the last month as it's put in a short-term low and has progressed higher. A lot of people view the copper as the industrial metal that kind of gauges global economic strength, and the fact that the copper is coming off is potentially a sign that China story is going to start becoming positive, or other types of things we can gauge from that. But ultimately, right here, we really just view copper as constructively moving to the top end of the range from the bottom end of the range. We just marked off the previous high. There should be some short-term overhead resistance right in this very 370, 375 level that we're at. That could create a short-term swing high. But overall, we don't view copper negatively anymore. Any pullbacks will probably emerge as buying opportunities. Next year, we're going to take a look at crude oil. And crude oil, while it tried to break out again, pulled back to the major support line. There is a very substantial amount of non-commitment here on crude oil. There's obviously OPEC meetings going on that are going to put things into account. But we certainly think that there's room for crude oil to rally to the top end of its range. But very clearly, there's no breakout momentum that has even started this process. If under the circumstances that crude oil does break to a lower low below this 85 focal point that we're identifying, there is room for crude oil to weaken all the way back down to the lows around that 79 level. But we right now do not favor that scenario. We think that the support has a very good chance of holding, and then we just have to see where the bulls will try to make a move to try to reverse it back to the upside to jumpstart a potential move. But right now we're sort of stuck in a very neutral holding pattern here with no clear indication that something is beginning. Next year, I want to take a look at gold futures, and we've over the last month and a half have been very bullish on gold. But we were talking about pullbacks that could have been started from the previous week. We were suggesting that there could be pullbacks down to 1650 to 1700. We already had a dip in there, and the question is, was that it, or is there still one more round of selling? Irrespective of that, there's no reason, in my opinion, to abandon our more bullish stance on gold. It's just simply not starting substantial momentum on the upside at this juncture. It would only take substantial deterioration below 1650 for us to have to rethink the strategy. And so long as the selling is contained into these zones, we'll remain our relatively bullish bias on gold. Finally, I want to take a look at the S&P 500, and we have a market that continues to hold up near the top end of its ranges. While there's plenty of room for the S&P to have short-term pullbacks that could see even 1370 to 1390 on the downside, even below that focal point. And while there's always room for short-term selling, we do believe that that November bottom was the material one, and the markets will not retest that low. And so even if we do have short-term weakness, it will likely emerge as a buy on dip opportunity in the markets. We do believe that there is room for the markets to make it back to 1465 highs, if not even break to higher highs toward 1500 in the first quarter of the year. But the one thing that we can say is that if the FOMC meeting later this week does not jumpstart a substantial move, it is very likely that the month of December may be a very sideways range-bound low volume event that allows the markets to consolidate and create a base from which we could have a very bullish January. But it is possible that we're not going to see any real momentum in the markets over the next few weeks. Just to make a few key intermarket observations, we've just changed our U.S. dollar stance on the short term to very average risk reward, reflecting on what happened with the euro. We believe at this stage the U.S. dollar will likely neither gain a huge momentum to the downside, but nor any huge momentum to the upside, which means that swings of $1.50 in the dollar index, either higher or lower, are likely. But it's not enough to warrant us to have a bias higher or lower, and so we're going to rate that very average. We do still believe commodities have the potential to strengthen. Gold and copper and all of these things look good. Oil's holding its support but has not been contributing to this outlook, but it doesn't change the fact that the risk reward proposition probably does favor owning crude at these levels. And when we go to U.S. bonds, we still do believe that the proposition is poor. Even if those selling doesn't kick in, the benefit of owning it versus the risk you take in owning it is just not good. In terms of U.S. stocks and global stocks, we do believe that equities will continue to do well, even if December is a relatively range-bound period. January, February, and March, the first quarter of the year, have the potential to be relatively positive for equities, and we want to continue to reflect that in our rating of that risk-reward proposition. So that's where we're going to wrap it up, and we'll see how everything develops into the FOMC meetings, but we don't see these ratings changing much over the next week or two. That was your Monday Futures Market Outlook. Thank you for joining me.